Let's analyze what does it mean for the markets. While yesterday, of course, you did see, all that knee-jerk reaction, that the fact that immediately after the announcement that came by on the capital gains taxation increase, you had the Nifty itself fall about 1.5%, and then towards the close, we saw all of those losses getting recouped. Sandeep Tandon, CIO at Quant Mutual Fund, joins in to analyze the day after the budget. Sandeep, hi, morning. What is your sense? I mean, while it's a given any kind of taxation and an increase thereby, sentiment negative. But do you think with yesterday's recovery, the market has digested that and it's yet another new day?
So frankly speaking, it's a very mature market and market has actually absorbed this shock. Okay. So if you could have asked me one day prior to that, if this happened, the market can correct, everybody could have told you market could correct 5%, 10% type. Okay. But finally, STT related to the option side, it was on the expected lines. So there's no major disappointment. Yes, obviously the long-term small change will not make any meaningful difference, but particularly on the short-term side will have some impact on the volume. So we have to see if there is a drift down, because both STT as a combination and this short-term exchange, if the volumes, the trading volumes can come down. If that happens, then it might have impact costs move up. Okay, and which may not be a great news from a institution like us, because ultimately it will land up in paying higher in terms of impact cost. That's the only worry I have. But any change takes some time. So maybe given the maturity and the interest in the market from the global participants also, I think this shock will be also be absorbed. Maybe it might take few more months in terms of volumes to come back. So I will watch volumes very closely. That's the only important takeaway from this. Otherwise, life remains normal as it is.
So while Sandeep, this adjustment takes place and the market and the investor fraternity tries to absorb the tax changes, do you sense some time-wise consolidation for overall equity markets?
So I completely agree with you. A market can consolidate even from the current level also, because this will take time. See, initially some short covering was also there. Look at the VIX collapse sharply. So a lot of people who were short on the options side, they or the put on the option and future both side, I think they covered. So that's one of the reason also that some amount of covering was there because of that. I think it can lead to smaller correction and consolidation. Answer is yes. And given the background, last week also on the channel I talked about. We are more worried about US because good amounts of compliancies were there, whether you talk about precious metal or some select base metal, the compliancy indicator was spiking, and that gives me discomfort, and market has also corrected. So given the background, if you have some turmoil in the global market, particularly the US side, then even market can correct here. But broadly, we remain constructive, like buy on dip sort of strategy. But if you ask me very openly, it's get correct and consolidate. But the best way is to play through sector rotation and stock rotation. That's what we do, and that is something we always recommend, irrespective of the market. You will get opportunities in the market. Look at the FMCG, which came back very thing. We were very early, right from January. We launched a fund around that, and we are beneficiary of that. So I think this is the way one should look for opportunity, because one should not exit from India, because we always say India, something has changed. It's a very unique situation. We have never seen this sort of opportunity, at least in my career. So I remain very constructive despite all these challenges. Correction, consolidation, a part of this journey.
Sure. Sandeep, before I get into individual sectors, I want to talk about the bond markets as well, because you do understand that faction of the market as well very well. Yesterday, you saw the yield ease to about 6.5%. What is your own sense? Or rather, brokerages are saying it could ease to 6.5% by March. And yesterday, we did see a reaction in the bond markets as well. I know you're an equity guy and so are all of us, but for the debt market, what does yesterday's budget actually signal?
See, if you ask me, from the bond market is constructive because government have showcased the determination of keeping an eye on the fiscal side. In fact, expectation was 5.1, it came up to 4.9. So I think it's a very strong message, despite they have not got the majority, and still they have not walked this path of populism sort of thing, though it was a very balanced budget. So given the strength in the economy and the focus on the fiscal part also, I think it's a good news for India, and it will help in the re-rating of the sovereign rating also, maybe in phased manner. So I'm from a rating perspective, sovereign rating perspective, all things steps in right direction, and whatever money flow which is expected will also support the rupee also. So I think from a larger perspective, it's very good. But if you ask me from a very longer term perspective, and I say, let's say next 5 years perspective, 6 years perspective, I think global interest rate trajectory is up. We are in massive bull run. Okay. So if you're talking about inflation as well as US interest rate, we have very absurd target for US interest rates. Okay. So it's not going to happen tomorrow morning. So maybe given the interest rate cut, which people are expecting, maybe next few months, there's a possibility the interest rate can correct and cool a bit. But if you ask me a longer term trajectory, one should be mentally prepared. They will remain elevated for long.
Sandeep, you spoke about FMCG, but what about PSUs? They've been the darling of the market. Yesterday, the first knee-jerk reaction actually came in the PSU basket, of course, the high flyers. Uh, but would you sense that the bull market in PSUs per se would continue? Or is that where you are going to see the ease off and the shake off happen and continue from yesterday?
See, if you I look from a more from macro, let's say we have been talking about the mild risk off period for the developed market. Okay, with that background, obviously commodity is also going to correct and consolidate. Okay, and even you look at here also when we're talking about the high beta names, which has seen a massive fall yesterday and whatever event which played out. Obviously, when you move towards safety, toward let's say FMCG or pharma names or maybe selected tech names also, then it's a very natural phenomena. When you shift from high beta to low beta, then obviously offloading will happen. And let's not forget they have been a massive bull run. So if they can correct and consolidate for a few more months, I'm not talking about 1 or 2 weeks sort of thing, maybe a possibility, maybe they can correct 3, 4 months period, and then they can come back again, because the broader trajectory of the PSUs are still up. Because I always talk about value as a theme, is a decadal opportunity, but no moves will going to be linear. So with that background, one has to look for, and within that also, you will get opportunity. Okay. If you sit down and analyze our portfolio, we also have pruned a bit, but where we have increased on the insurance side, we have increased on the energy side. So it's a combination, when you see some amount of euphoria getting built in certain pocket or certain sectors, then you need to prune. And when you see again they are back in the neglected areas or some sort of hatred feeling, then that's a time to rebuild your position. So prima facie, I remain constructive. Maybe correction and consolidation, I'm not ruling out.
So, Sandeep, do you actually see any kind of rotation happening in the market? Part of that rotation has already played out ever since IT earnings started to trickle in, and ex-Wipro, of course, or for that matter, FMCG. Today, Unilever has posted good volume growth, so today the stock is going to react to that. And I ask because of the market positioning ahead of the budget. I mean, month to date, the Nifty alone had already moved up 4%. So, the index aside, what happens to various sectors now? And do you see any shift from, say, out of small and mid caps into large caps? What do you think the portfolio allocation is going to be?
Very clearly shift, which I talked about, from high leverage and high beta name towards low beta perspective. Then obviously, uh, if people are moving towards large cap, and even the sector we talked about, let's talk about FMCG. Predominantly, majority of the stocks are large cap, so you don't find too many smaller caps names. If you look at a broader category of consumption, you will get mid and small. But when you look at specific FMCG, majority, maybe 70-80% companies are large caps, so bound to move in that direction. And since we are also talking about a mild risk of phase, which clearly endorses that it makes a lot of sense. Safety is much more, even from a valuation perspective, the large caps valuations are much more attractive. Again, nothing is absolute in life. Relative is very important. On relative basis, they are more attractive. So when you see some sort of risk of phase coming in, people tend to shift. And that's a phenomena which we have seen for last many weeks. Actually, it's not only for last, this phenomenon actually started pre-election also. So I think that trend can continue for a while.
Sandeep, what happens to the popular pockets, your defense, EMS themes? And I ask because that's where you are seeing that exuberance and rich valuations already quoting up. I mean, not to say there are not other sectors which are also, quoting at peak valuations, but in specific, these two pockets, because you track these closely as well. EMS as well as defense. What should investors do now? Should they be putting fresh money to work if indeed there is a correction? Should they hold on to their positions if they've already not lightened up their positions in these two sectors?
So from a longer term perspective, both EMS and defense we like because there will be growth opportunity, and I think they will demonstrate the highest growth. And even from the defense on the order book position point of view. So that way, if somebody has that 5-year horizon, 10-year horizon, then they are very constructive. But if you ask me from a very short term and even let's say medium term perspective, I think valuations are pretty rich. Yes, we are seeing our euphoric indicators for both the sector has spiked sharply. That's one of the reasons we have exited completely from both the spaces. And we would like to wait for opportunity to rebuild. So prima facie, not negative on the sector, but given the relative high valuation and the hype which we have seen and euphoric moves which happen in select defense and EMS names, we like to avoid at this point in time. But somebody, again, it's a investment horizon. Somebody has 5-10 year horizon, it still makes sense. But given the mild risk of phase which you're talking about, it doesn't make sense for us to remain. Then maybe better other opportunities are there, which gives me better risk adjusted returns.
Please don't stop there. Do highlight for our viewers where is it that you're finding better opportunities or at least scanning through?
So if you really look at in this budget, I think one area government talked about a lot of emphasis of late has been on the tourism side. Okay, despite like now the problem with the tourism sector is the opportunities are not very meaningful. Okay, and so easiest space which I think we like a space like hotels as a sector. I think that's the one, and even the hotels rates in India is significantly higher than even Switzerland and the European countries also. So given the demand supply constraint, which has happened maybe down the line 3, 4, or 5 years, you might see more supply coming. But given the business activity which has picked up along with the tourism and post-COVID, some mindset has changed. I think that's the one sector which we think has potential to move up. Even insurance sector, if you look at, okay, within the BFI size space, insurance has been a laggard, okay, for last 4 years, whether you talk about life or general or even the health side. Okay, so I think that's a good opportunity both in the private sector as well in the public sector. That's another area which we like. Okay, and apart from our FMCG themes continue, pharma themes continue, larger infra theme continues. Okay, maybe capital goods have similar problem like EMS and the defense. They're also very expensive, so we exited that also. So, but larger manufacturing and larger infra theme continues. So one has to identify opportunities, where you get better risk adjusted return. That is the trick right now because market, uh, I always say that easy phase of bull run is over. For last many months I'm talking about, but we are in decisive bull run. Let's not forget that. In decisive bull run, if you have to manage, then you have to manage through sector rotation and stock.
Sandeep, I also want to talk about, what you feel about global markets right now and led, of course, by the US equity markets because they now have a big event. I mean, for us, we're done with elections, we're done with budget, we're through with almost one earnings season as well. But given that, latter part of the year, you've got the US election slated and all that's happening now with the presidential race, and the fact that, it was a global rally that we were also part of. US equity markets have also done really well. What is your own prognosis on what the global markets led by US are going to be like for the latter part of the year?
See, the way I look at the first point I talked about complacency, people are very complacent. Okay. And whenever people are very complacent, it means the vulnerability factors are on higher side. Any negative news can lead to a massive vulnerability. That's the one issue. And we have seen something played out very recently. Second thing, what we have to understand, if you sit down and analyze rationally the cross asset, cross market data, then what we are seeing that employed walls of the all the asset class has potential to inch up. Okay, and if I ask me, inch up could be a very mild word. It has a potential to spike sharply, and that's the background. And this is something what our inflection point data is endorsing. So we are very cautious on the global markets. And it is very premature to say that they're going to collapse or this will happen. But what we are saying that the employed vols will spike. So volatility of the global asset class will going to inch up and move up sharply. With that background, one has to play very safe. Okay. The safety will be more important. This is not the time to take extraordinary risk given the vulnerability which is there on the global market. Our worry is not India. If you ask me, India which has corrected sharply because it was an event earlier, it was election, now it's budget. So I'm not that concerned about India. If India also correct, with the background will be global. So my worry is global, and we are tracking these global data points very closely. So it's very important to uh, analyze these things on continuous basis, because early signs of inflection point, I say early signs of disturbance are there. So we like to be very watchful and cautious about it, but we are not going to take any aggressive stand unless data point deteriorates significantly.
Okay, caution on the global markets, and yes, maybe some time-wise consolidation in store for India as well. Sandeep Tandon, great to have you on the show. Thank you so much for speaking with us.
Thanks for inviting us.
Okay, that's the view coming in from Quant Mutual Fund. Bunch of interesting ideas as well over there.
If you like this video, then like, share and subscribe to ET Now.